Thank you, Michael, for the introduction, and thank you for the opportunity to come in today and talk to you a bit. As Michael said, I wear a whole lot of hats, and it's really difficult getting dressed in the morning, but I do work as a commercialization advisor for the government program Accelerating Commercialization, which is a mouthful, and I'll be covering a little bit of that at the end. I have had 3 companies, 2 successful exits, but I say 3 successful companies. Pavtech is a respiratory protection device company, and I'm chairman of that. I've been involved with that company for about 3 years as an investor and as a chairman. And Springboard Enterprises. So I come from all over the place, but today we're going to talk about what I want to do is kind of give you a high-level view of capital raising and some of the terminology and some of the expectations that you might have going into different levels of capital raising. The most important thing is that you remember it's really an up and down ride. If you're capital raising, it's going to do a number of things. It's going to you hang on to your hats. It's like being in a dinghy in the middle of the ocean in a big storm, and it can be soul destroying. So don't do it if you're weak of heart. So yes, so I have been there. I've done all of these things, and I guess that's why I was asked to talk today. Credentials. So why do we innovate? Why do any of you innovate? I mean, it's not because it's the easiest thing in the world. Anybody who has a company knows that. So why do you do it? We do it because we like to solve problems. So if you have a company and if you have a product, a service, whatever you have, hopefully what you're doing is solving a problem, because that's kind of at the base of a successful company. But getting from your idea to a successful product into the market is a very confusing path. So today I'm going to talk a little bit about the state of play in the capital raising or in the investment community, a little bit about when do you raise, how much do you raise, where do you go when you want to raise, what do investors want, what should you expect from them, some of the resources that are available to you, and also some alternatives to doing equity raising. So the biggest reason why you use other people's money to grow your company, or the reason you need money to grow your company, is because the failure rate of underfunded companies is huge. And so therefore, if you really want to give yourself the best possible chance for success, you need sufficient capital. And if you get sufficient capital, what you want to do is you want to use it to grow your business. And really everything up before that and after that is negotiable, but really it's to get a product into the market. So some of the stats, these are either very encouraging or very discouraging, depending on where you are. But it was really difficult for me to get current statistics on how much is invested in Australia in this space. I Googled it like everybody would and read tons of reports, and everybody seems to have a different figure. The closest I could come, the ABS figure on this, is that in the private equity and the venture capital markets in Australia, in 2012, 2013, there was $7 billion invested. Well, the PE market, the private equity market, is the very high end of investment. If you carve that out and say, okay, anything outside of private equity in the early stage space, we only invested $114 million into that space in approximately 100 companies. Now that's not a lot. I mean, if you think about it, that's nothing. It's a very underrepresented sector of the Australian economy. And when you go back to that $7 billion figure, 16% of that, which is over $1 billion, went offshore, into offshore investments. And if you read the statistics in that same year, the number of new investments dropped and the size of the deals dropped. So we're going in the wrong direction. I have read sort of indicative comment about it starting to shift back again. But this trend for Australia is not a good story. If you switch that up north, the US invested about $30 billion just in the venture and startup space. 12 billion of that goes into the seed stage and the early stage, which would be probably up through what we call Series A. So it's a remarkable difference, and no wonder, when we're raising capital, everybody says, well, I'm going to go to the US and raise because Australia doesn't have money. So I'll be talking a little bit more about that too. Rest of world is way above us as well. These are in the billions. So when do you raise? When is it time to raise in your company? And certainly not when you're broke. It's probably the worst time to raise. You need to be always planning for what is your next commercial step. So even if you're a tech company at the very beginning and you're looking and you're saying, okay, well, I've got I'm starting to look at a tech product or my software or my app or whatever you're doing, you say, okay, to get it to market, I'm going to need X number of dollars to do that. I still have 50 grand in the bank to get me through development, but that's the time, if you really think that you're going to have something successful at the end, that you go out and start talking to people about the next round. So, various stages. Bootstrapping, everybody knows what that is. That means you sell your furniture and your kids and your dog and mortgage your house and you fund what you're doing. Crowdfunding, somebody's talking this afternoon about that, so I won't go into that, but that's obviously where you put it online and you get people, a bunch of people to come and support you. The next one is friends, family, fools, and credit cards. So that's when you start to get a little bit more serious, and you get other people who are willing to put their money behind you. And God bless you. I hope you have very patient family and very patient friends, and a good credit card balance. But that is how a lot of people get started, and that's really your seed stage. Early stage development. That's when you start to look externally for money into more sophisticated investors like angels or high net worth. Commercialization and expansion, next level up. And then growth, next level up, and IPO is kind of the top rung. So this is sort of who plays or who you would go to in those different spaces. Early stage development is one of the areas where there is more money right now than there is in the next one up, which is the commercialization, where the venture and the private investment people live. So that commercialization space is what we often call the valley of death. And there's a good reason why we call it that, because there isn't a lot of growth money in Australia at this time. So how much do you raise and why? For what purpose? So roughly speaking, in each of these different phases, these are the kind of numbers that you would be looking at. So in your seed early stage, you would want to get somewhere between 50,000 and 150,000, depending on what you're doing with your money. The angel high net worth, 100,000 to $500,000. First Series A, somewhere between 1 and 5. Second Series A, somewhere between 3 and 8. And if you go into Series B, it would be over $10 million. These figures, if you are raising in the US, tend to be slightly higher. So what does a seed stage round look like? And what would your company look like if you were to go out and try to raise at this stage? Generally speaking, if you're a tech company, anybody here a tech company? Oh, okay. Non-tech companies? Manufacturing? Biotech? Okay. So if you're a tech company, you've got your idea, you hopefully will have built an alpha of that idea. You would have technically tested it, make sure it works. You also would have, and if you're non-tech, you would have built a rough prototype, make sure the prototype works. It may not look pretty yet, it may not be your commercial version, but it's enough to test with a customer or a potential customer. So the assumption is you've tested the technical veracity of what you're doing, and you've also somewhat tested your commercial market by saying, here's a product, would you use it? If I give it to you for free for a little while so you can play with it, would you tell me what's wrong with it? And then I'll come back and fix it. So that's what seed money does. It really allows you to fine-tune what you've built and then make sure that what you've built applies to your customers. A business plan is really a good idea. I can't tell you how many companies, though, that I talk to don't have one. It's actually worth the time to sit down and map out what you want your company to be like when it grows up. Because then you really understand what the different stages of development or the stages of commercialization that have to happen. And when you sit down in front of an investor, they're going to ask you, how are you going to get from where you are today to where I'm going to get when I get my money back? So you have to have a rough idea. Oftentimes you won't, you can go online and get a business plan outline. Anybody can write one. It is a living document. It is not a set in stone document. So don't be afraid of it. Write it, revisit it every 6 months or every month or every week. It doesn't matter, but just write it down. And this last point about co-founders. There's a lot of statistics that show businesses with co-founders are more successful. Now, having founded a couple of companies, one by myself and the next one with a partner, I can attest to the fact that if you have a business partner, it does help you be more successful. You have somebody else to talk to. You have somebody else's viewpoint on how to proceed. Hopefully that person has a complementary set of skills that you can rely on. Because I used to say, when I had was the founder director of my own company, I used to say that the scariest thing to me was just having only my own voice to listen to. And I think that is a true statement. And if you don't start with one, find one. Find one that you trust, that has the passion for what you're doing, that brings in skills that you don't have. Hopefully brings in a little money as well, so there's vested interest. And then make sure you have a good partnership agreement. So when you get into the next round, which is a little bit more money, your angel round, hopefully by then you've tested your beta, and I would say tested it with a number of customers, not just one. So you've got this beta, you put it out. If it's a tech company, if you're a tech company, put it out to a number of customers and say, please test this for me. This is where you're testing the robustness of what you've built, as well as the customer pull. You need to really understand your target market. So I get companies who talk to me a lot and say, well, I've built the best app in the world and everybody's going to use it because it's just amazing. And I said, well, who's going to, I guess app's not a good idea. Piece of software. Best thing in the world. It's going to solve all the problems, everybody's problems, et cetera, et cetera. And I said, well, who's your customer? Well, it's going to make everybody's life so much easier. So it's the people who are going to end up using it. In actual fact, the customer was a provider of services to that end user. So the customer, the one who's actually going to pay for it, would be an entity, a bank, or a medical center. In this particular company I'm thinking of, the medical centers were going to pay for it, not the patients who were going to be using it. And he had just got it backwards. He thought the patient was the customer, but in reality it was the medical centers who were the customer of this software. So make sure you've worked that through. Who's actually going to pay you for your product? Market entry is a huge thing. How are you going to actually get the sucker into the market, whether it's a piece of software or whether it's a widget or whatever it is, it could be a service. Know how you're going to get it into market. Pavtek's a great story of, we just built this amazing thing, amazing respiratory protection device, changed the way people were protecting their lungs, and thought the whole world's going to come and buy one because it's so awesome. Well, the reality is people don't buy masks that way. They buy masks from a distributor. So we had to back up and and change our entire strategy around the distribution model. And so that happened quite quickly. We learned that very quickly several years ago, but your assumptions have to be tested. And so make sure you understand them before you get going. Scalability. If I'm going to invest, I expect you to grow. So don't come to me as an investor and say, I need your money because I'm going to build this and I'm going to sell it in Sydney. It's going to be awesome. I want to see it grown, not just Sydney, not just Australia, globally. And revenue model, I've touched on that already. So the next phase, the venture capital phase. And yes, forces of evil do exist in the venture world. I will admit that. But it doesn't have to be as scary as that if you understand what motivates a VC, how to talk VC language, and how to get what you need from a VC. Now, I will say that in my experience, there was a difference between the venture capital deals that I have run across in Australia, sort of historical deals, and certainly the ones that I've been a part of in the US. And I'll cover some of those differences on another slide. But the good news is that the venture community in Australia is getting more mature, getting more understanding, and culturally shifting, so that there is good news in this sector. So venture capital firms, I thought was a very good description, are professional institutional managers of risk capital that enables and supports the most innovative and promising companies. But the thing that struck me the most about this is that they do this because what they do, or what they want to do, is fund ideas that threaten the big boys. So that puts them in a very high-risk situation. And the other thing that was interesting is that it's a 5 to 8 year investment to get that company to get return on investment and build something of value. So anybody who's thinking that they're going to, that the ideal is to flip it in 2 years, start it, flip it. It's a waste of money, a waste of time, a waste of energy. If you haven't got a plan that says you want to build something and it's going to take you 5 to 8 years to build, you won't be doing your company or your investors any the right favors. So all of that just equals a lot of high risk. So what happens when you walk in? So for every 100 good ideas that walk through a VC's door, 10 will get a second look and 1 will get funded. So you can see why they get cranky, because that's a lot to weed through to get one investment. And those are probably low numbers. I probably go through twice that many just in my government contract job. So what do they look for? What stage should you be when you go into a venture capitalist office? So you should have a product in the market. You should have good traction in that market. It should be at a minimum one geography, so good market traction in Australia. If you're a software product, that could be broader, it could be measured differently. Certainly in software products, that's measured by people, not revenue, or users, not revenue. You should have a revenue model that shows when the money's going to start coming in. And those in tech, I know that there's 2 different models that exist, one for high tech and one for the rest of the world. And high tech is obviously measured by the number of people that you can get using your product, and if you're ever profitable, that's kind of a bonus. Also, when you get to this stage, you want to make sure you're not a one-trick pony. So don't have one product and say, I'm going to save the world with one product, I'll never change it, it's good enough. There's always a pipeline expectation that will either enhance your market or get you a new market. So be thinking like that. Be thinking that if I'm going to take 5 to 8 years to build my company, what else can I do? And often pipeline, especially if you're non-tech, pipeline is a really good way to do that. Have a good solid business plan, a good solid revenue model, know what your ROI is going to be at the end and where your exit potentially could be. I'm not a believer of the last slide on your deck saying, and we're going to sell to Microsoft for $1 billion at the end, and we're going to do this in July 2016 because we're so wonderful. Just say you want to build. The best thing to do is say, I want to build this company, and when we get to this point, we will be an attractive acquisition. And here's the potential companies that would be interested in such a thing, and then do some comps if they ask you to. But a lot of this is about what are the VCs going to ask you to produce. So where do you go to raise? So for Australian companies, your choices are sort of Australia, Silicon Valley, or the US, China, and then there's the non-dilutional government money that if you're lucky enough to get access, that is available. So what is, and where, no matter where you go, these principles apply. So remember that whoever you take money from, you're going to be married to till death because they are there. They own part of your company, so you better get along and you better trust them. There's strategic investors, there's passive investors. Depending on what your company is, one or the other might be attractive to you, more attractive to you. Passive is actually probably more attractive in the earlier stages of developing your company. But the more mature you get and the more you start to grow, those active investors can bring huge value to your company. And that's what venture capitalists are supposed to do. Venture capitalists are supposed to invest because they can add value to what you're doing. In the old days in Australia, that wasn't always the case. Venture capital was kind of passive and controlling, but I think that, like I said, that's shifting a bit. But they can really make you far more successful and valuable if you go with the right partners. The terms, everybody says, oh, what kind of terms should I ask for? Well, that's like saying, what am I going to eat for the rest of my life? You don't really know until you get in there and start to do that. And I do have a slide on the different kinds of things you should watch out for. And do your own due diligence. Go talk to other companies that these investors have invested with. Just ask them, how are they? Are they helpful? Are they horrible? Are have you benefited from that relationship? So they're doing due diligence on you. You should do due diligence on them. So the first step in this process is pitching. And you need to really, there's a couple of things you need to remember, I think, when you pitch. And culturally, it's actually different to pitch in Australia than it is in the States. So any investor is going to be looking for the reason to invest for returns. They're going to be looking at the team. They're going to be looking at the structure of the investment. They're going to be looking for the viable liquidity event, whether it's an IPO or whether it's a trade sale. They're looking for impeccable technology, for a realistic plan, and value. So all of these things apply no matter who you're talking to. The nuances are in how they prioritize those things. So in the US, they're looking for passion. So if you walk in the door like me with this and kind of go on monotone, they will show you out and say, thank you very much, we'll let you know. But if you come in so excited, and it doesn't matter if your slide deck doesn't have all the information, it really doesn't matter. But if they see that you are passionate about what you built, that you believe in it, that you put everything that you can into this, you've got a plan, you've got a product, you've done most of your homework, that's going to get you that second look. The next important thing is, can they value add? Can they help you become more successful? So those would be the two top priorities for a U.S. investor. Everything else is the same probably for anyone. In Australia, it's a little bit different. My experience has been that the investors look at you and they say, well, show me your good idea and tell me how much money we can make at this. And then, oh, by the way, how's the team? So, and team, to me, a good team is essential. So when I've invested in teams first. So Paptec's a great example. I did a piece of work for them, just some consulting work about 4 years ago, and I fell in love with the team, not the product. The product I thought was kind of big, and I thought, who's going to buy something like that? But the team was so incredible. They were out of ResMed, they were passionate about this, and invested their own money, and built something, and were ready to commercialize it. So I put my money into that, and it was a rocky road. We went up and down, and almost went under, and everything else. And this team, not just the founders, but the whole team stuck through that and got to the end to where today, after being almost insolvent 18 months ago, that company now is going to hit $3 million in sales. We just got approvals to get our product into the US. We've got a trajectory that the sales are, and we just are in the middle of a capital raise. So that's also why I'm not sleeping. We're in the middle of a capital raise, and it's been full on. I haven't slept in 2 weeks, so that's what you can expect. But that's it is about the team. A good team, you're going to get through the rough spots. If you don't have a good team, those rough spots will kill you. Then there's China. Now, China's emerging as this very interesting investment option, which is a relatively new thing for us here in Australia. There's a lot of money there. There's a lot of money, there's a lot of interest. There's a lot of interest in investing in Australian companies. It's a tricky market, and I wouldn't suggest doing it without being careful and doing your homework. But if you do look to China, it's often going to be in the form of an investment or a joint venture, or taking manufacturing and distribution rights, which isn't necessarily an all bad thing, because again, coming back to Paptec, if we go into China, it would be so difficult for us to manage that process and know where to sell and how to distribute, the language barriers, the culture barriers, everything else. In a relationship like that, what could be attractive in that situation could be to do a joint venture, to give them China and look at the opportunities around getting manufacturing costs down by letting them manufacture everything under a very tight quality control. So there's just you can be very creative about that, but there is money, it is accessible, just probably going to take longer and probably needs a lot more care in building that relationship. So now you've decided who you're going to talk to, and you've got your pitch all ready, and they've called you back, and they're going to say, okay, let's talk about this. We'd like to give you a term sheet. First question they'll ask you, what's your valuation? So who knows what the valuation of their company is today? Okay. Do you know that because?
Because I've raised fund.
That's a good way to do it. Who else raised their hand? And how do you know?
Understand it on a number of sales terms and valuation.
So you've had an external person come in and do a valuation for you. You've probably got the only right answer as far as how do you set a valuation. It's who's willing to pay that. Simple. It's like selling a product. What do you sell a product for? Well, whatever anybody's willing to pay me for it. But getting a professional evaluation is one way of doing it, and there are formulas and there's lots of things that you can take into consideration. At the end of the day, it's a black art. Nobody can tell you that your company is worth this or this or this. It's what am I willing to pay to be a part of this. So think about that carefully. And when I had my companies and they'd ask me for a valuation, I would never answer that question. I'd say, well, let's talk about where you see this company. What is it that you think we can do together to grow it, and what would that look like to you? So you interview them, you get them to give you feedback as to what valuation you think they're going to offer. And my experience in Australia has been quite funny, actually, to some of the valuations that come back when we've been capital raising this last time, and they come back with a number, and I have to laugh, and I have laughed. But the funny thing is they know it's crazy, and some of the funds are just geared that way, and that's the way they do it. But do put that sort of at the bottom of the negotiation list. Preference versus ordinary shares. VCs are probably going to ask you for preference shares, although it's not a given. So just, and all that means is that they get special rights over everybody else. But you have to be careful in preference shares and issuing preference shares too early, because it does sometimes get in the way of future capital raises as you grow. So what we've done is try to keep it at ordinary as long as we possibly can until we get to that point where that very significant investment comes in where you have no choice. But preference shares also come with something like redemption clauses. Now those redemption clauses are the ones that can kill you, and they're the ones that can get in the way of future investment. So make sure that you get good legal advice about that. Liquidity, look out for who has control over when and how much in the liquidity, because they will specify often they want to start doing a liquidity strategy in 2 years for a minimum of $20 million, when in your head you're thinking, I want to spend 4 or 5 years and get more like $100 million. So make sure you're on the right page about liquidity rights. Control of the by the investors. Who has control? The investors and the board. Now that's a tough one, because some of the term sheet of the company, but they get all the control. Now that, sometimes is not acceptable. So you have to think about that. And they can either do that through your investment agreement deed, or they can do that through controlling your board by putting more, getting more power on your board than your other board members. And then ESOP. God love it. Hopefully, the government is going to do some work on the ESOP tax rules, but share the love, because if you want your company to be successful, make those who help you be successful, reward them, give them a piece of it. It can be a small piece, whatever, but the best way to build a solid company is with a good team. The best way to engage a good team is to make them feel like they're part of building something that they're also going to benefit from. So once the ESOP tax rules get sorted July 1, God willing, make sure there's one of those in your company. So the negotiation part is also very important. You need to realize it's all a negotiation. Nothing, no matter what a VC tells you, or an investor when they walk in the door, everything is negotiable. There's no standard agreement. So I would highly recommend, if you haven't done deals, get some legal advice from somebody who's done a lot of them, or an investor who's not related, who's done a lot of them, or an entrepreneur who's done a lot of them, because you can save yourself a whole lot of grief. And if it doesn't feel right, how do you deal with that? One of these terms is keeping you awake at night. Talk to the investor about it. Say, look, this is keeping me awake at night because this is potentially the consequence that I feel is not in the best interest of my company. Doing that, they have something to work with in the compromise. They know what's bothering you and why. So a compromise can then be worked on. If you just say, no, that's not acceptable, it's this. But if you explain why, most good VCs or investors will work through that term with you. And if they start bullying you in the courtship, forget it. Is it better to take bad money than no money at all? Probably not. I wouldn't. So it can be a really horrible experience to get in with the wrong investor, and it's better not to get in at all and figure out plan B, C, D, E, it doesn't matter, but don't take bad money. So if you need help at the early stage, there's all kinds of organizations and incubators and accelerators around town and groups. There's other, tap into other entrepreneurs. Most successful entrepreneurs, especially those who have built global companies, are more than happy to help. That's culturally one of the things that the U.S. has that is starting to emerge here in Australia, and is that giving back. So I've been a successful entrepreneur in the U.S., and I was because I had other people always offering to help. I didn't even have to ask. They would come to me and say, can I help? I can introduce you to this person. I can introduce you to that, or going through a business plan with me. I had more volunteer help than I could have ever wanted. So that's why I'm committed to doing the same, that giving back. And there's a lot of people like me out there as entrepreneurs who are more than happy to help you through this process. So this is just a bit of a slide about a handful of the incubators and accelerators that are around town, and some of the kinds of terms that you might expect from them. Scale is the anomaly in here, in that they only fund women-led companies, and they're definitely an angel group, and they're Melbourne-based. But for those women in the audience, they're a very good source for seed and early-stage funding. Now we get to the government bit. This is my obligatory government talk. So there are grants, but truly, for anybody developing a product, the R&D tax incentive is the best deal in town. It is at I think it's down to 43 cents now. It was 45 cents, but you get literally a refund of 43 cents on every dollar you spend in R&D. Now, I highly recommend that you go to somebody who really knows this, who really knows about the R&D tax incentive. The big firms all say they do, and they charge a fortune. There are other people, though, who do know a lot about it and can get you. Pavtech survived on R&D tax refunds for a number of years. So it's a very, very wonderful thing that the government has come up with that helps promote innovation. It's about the biggest thing and maybe the only thing, but it's an incredible program. There are state level grants, so just check the websites. There's federal government grants, and I'll talk about accelerating commercialization in a minute. There's programs, and I've highlighted Springboard because I will talk a little bit about that on another slide, but there's groups like Heads Over Heels, TIE, which is for tech companies, and the IBM Smart Camp, which is also, it's not just tech companies, but what they do is they look for companies with high levels of innovation that might serve their customer base. So it's not just a product that serves their product pipeline, but also might address very large customer base if they have in particular sectors. So don't think you have to be a tech company to get into the IBM Smart Camp. It's a great program. So the federal program. So I can't say all the acronyms because I've memorized them, but it's government, so it's a ton of acronyms. So I'm just going to whip through this pretty fast. So the new program, umbrella program, is called the Entrepreneurs Infrastructure Program. Underneath that, or what sits under that, are three programs. There's the Business Management Program, which is the old Enterprise Connect program, if any of you are familiar with that, which is basically for SMEs who are looking to better manage their company. So it's really a business management assessment tool. The Research Connections is that I think is a legacy program for what it was called, but connecting companies and researchers at universities. And then the Accelerating Commercialization Program, which is the one I'm involved with, is the grant program that replaced Commercialisation Australia. So if you can remember all that. Where it sits, though, is in this valley of death space. So R&D tax incentive, NHMRC if you're biotech, all of the R&D side of things is relatively well looked after. On the other side, with EPIC, who's also talking this afternoon, and some of the, and then banks actually get involved when you're in large manufacturing contracts. That's kind of taken care of. The middle ground where you want to commercialize in those early stages is where this program comes in. So it's a competitive merit-based program, and it was reopened on the 1st of November last year. It gives grants up to $1 million, and that's a dollar-for-dollar matching grant. So if you have a commercial project within your company and you say, okay, well, I think it's going to cost me $1 million to do this, to get my product into the market, get it into a global market, and I need $1 million to do it. You could apply for a $500,000 grant and you put $500,000 of your own money against it. It is competitively based. There are certain criteria that you have to meet. So there's eligibility criteria, which means you have to be under $20 million turnover. There's you have to have IP. You have to be ready to commercialize, and you have to meet the need for funding criteria, which is one of those wonderful gray areas. It doesn't mean that you're broke at the end. It means that you've been out, you've tried to raise money to do what you want to do. You maybe raised half of what you need or 3/4 of what you need, but to really make your company successful, an extra X amount of grant dollars will help you leverage that money that you've raised and be far more successful. That's the kind of company we look for. Then, after Oz Industry evaluates your eligibility, then a bunch of people like me who are externally contracted, and we're all ex-entrepreneurs and investors, we do due diligence on the application and the company, and we do an assessment. So if you're accepted into the application pipeline, you're fully assessed as if we were an investor, and then recommended or not recommended. Springboard, very quickly, Springboard Enterprises is for women-led companies, and again, it's a competitively based program too, but it surrounds the women with a coaching team that helps them become what we call investor ready. Work on the pitch, work on the details of inside the company to make sure that she's investor ready and help her with introductions. Springboard stats in the U.S. This is these were our companies from last year. The ones you might know is Simone Ailes from 365 Cups and Katrina Wallace from Flamingo. Both have been in the news lately, so they were part of our program for last year.